First of all, we would like to thank you for participation in Kotak Technology Fund. While technology as a sector has not delivered much and there is uncertainty, probably that is the best time to invest. About 4,000 plus partners and 35,000 plus investors have given us 290 crore in this NFO. We will deploy this over next 30 days as per SEBI regulation and will recommend you to do SIP in technology fund to average during this uncertain times. While there are worries thanks to artificial intelligence and global slowdown, valuations of technology come fairly reasonable. Coming to the global economy, well, as of today, it looks like world will slow down from a growth point of view, but avoid recession. Next slide, please. Inflation is showing signs of easing across most parts of the world, and it looks like that central bankers will finally win over elections. Now, they are also likely to cut interest rates, especially in second half of CY24, if inflation comes down and growth needs to be supported. If we look at Eurozone, their economy is coming under pressure, and the composite PMI of Eurozone is showing recession. Next slide, please. The development government bonds outstanding is increasing at a rapid pace, and more importantly, refinancing also will happen at a higher prices. China is facing a deflationary situation. Inflation is now into negative zone, and because of that, Chinese central bank is not able to protect its falling currency. If we look at China, their foreign direct investment has dropped significantly. And since there are worries about the data released by China, people use proxy. One of the proxy has been iron ore. Generally, it has been seen that price movement of iron ore is in tandem with Chinese GDP growth. Now, iron ore prices are falling, but Chinese GDP growth has not decelerated in the same fashion. Could this be the precursor? And both drop in foreign direct investment and GDP indicating some amount of slowdown. Coming to US economy, Fed usual has maintained a very, very delicate balance between rate and growth. The fiscal policy in US is fairly flexible, fairly on the higher side, and which is why growth is getting supported. Now, we are seeing contradictory data from US. On one side, Fed's favorite gauge of recession is showing higher probability, but at the same time, people are pricing in higher inflation. Both of these things does not coexist together in normal time. The commercial real estate in US is under severe pressure as employees prefer work from home, and clearly this is tip of an iceberg. Next slide, please. As more than $3 trillion of US commercial real estate witnesses debt maturity. While America is a mighty nation, 60% of Americans does not have bachelor's degree. The debt creation speed of America is amazing. Nowadays, they just need 100 days to build $1 trillion of debt. At some point of time, someone will have to pay for that debt burden. In the speculative grade, default has started increasing, probably showing the risk to the economy. The Magnificent Seven shares, including Alphabet, Amazon, Apple kind of companies, insiders have started selling. Do we believe that Magnificent Seven has peaked out? Well, they are available at 45 times PE, which is lower than some of the previous bubbles. Their rise also is not as high as witnessed during previous bubble. So who knows? Corporate America is looking to raise prices as their input cost continues to remain on the elevated side. This does not bode well for inflation. Will we witness a rebound in inflation like in the 70s and 80s? We believe Fed will be cautious in cutting rates and providing liquidity so as to not repeat what happened in the 70s. While rate goes up step by step like an escalator, they do come down like an elevator. But do remember, this elevator's button is in Fed's hand, not in market's hand. The last Fed hike to the first Fed cut is about 8 months, though in the 70s that was about 18 months. Now, in the month of March, 8 months average between last hike and the first cut will get completed. Market expects Fed to cut rate by mid 24, but on extreme, we have seen Fed not touching rates for even as long as 18 months. We believe market will readjust their pricing of Fed rate cut towards end of 2024. The street estimate of Fed rate cut varies significantly from 75 basis point to as high as 225 basis point. We don't know who will be right and who will be wrong, but we do believe market still has to make readjustment to Fed's cutting rates from mid 24 to late 24. Coming to Indian economy, headlines continue to remain positive. Next slide, please. We have managed inflation and growth trajectory far better than most of our peers. We are right in the middle between growth and inflation paradigm. We are on our way to become third largest economy by end of calendar year 2027, overtaking Germany to touch $5.4 trillion of GDP. We have become engine of global growth, as on an incremental basis we are contributing high single digit to global growth compared to the previous periods where we used to contribute low single digit to global growth. Our growth is real. There was a time when we were moving in tandem with sub-Saharan Africa in terms of our GDP. Today, India's GDP growth is accelerating over sub-Saharan Africa. GST collection is remaining above 1,60,000 crore for some time. Household credit to GDP ratio is still moderate compared to global standards. Real estate sector, after a subdued growth over last 13 years, is expected to accelerate. Vehicle sales are starting the year with a bang, with almost 15% growth in total number of vehicles sold, including two-wheelers. Banking sector is witnessing double-digit credit growth. Their balance sheet has become fairly transparent and believable, as NPAs are fully provided for. Electronic exports from India is rising rapidly thanks to mobile phone productions. India's capex cycle is led by government, and in capex cycle there are two players: government, public, and corporate and retail individuals, private. Whenever India makes more investment in infrastructure, we see outperformance in market. Whenever India makes less investment, we see market underperforming global markets. Now, investment has started picking up, and if we can maintain this run rate, our outperformance over global market should be easily manageable. The crude prices, despite Israel-Hamas war, has fallen about 12% from the top and provides a very good support to Indian economy. The government, despite election pressure, has kept subsidies under control, and lower subsidy in December 23 quarter has resulted into GDP coming at upwards of 8%. The vote on account pleasantly surprised market by keeping a target of 5.1% for fiscal deficit. This is a step in the right direction. Undoubtedly, there are challenges for Indian economy. The rural consumption is not growing as fast as urban consumption. The mass market products are not selling as fast as premium market products. Bottom end of pyramid consumption is not growing as fast as top end of pyramid. The consumer sentiment remains above pre-COVID level, which bodes well for consumption in the days to come. One worry for India is slowdown or retrenchment in IT sector. Normally, they absorb about 500,000 workers. This year, there is a very, very low intake of about 70 to 80,000 fresh engineers. Converting that economy into broad market, well, thanks to our recent run, we are one of the best performing market over 20-year period to our peer group. Our weight in MSCI Emerging Market Index today is around 18%, and that's function of performance as well as efforts put in by the government. I had written an article 5 years back why MSCI should not increase China's weight and why India's weight should be increased. Lot of effort were put in by finance ministry and regulators like SEBI to ensure that India's weight in MSCI Emerging Market Index moves from 8% to 18% rather than go down to 6%. This article gives some insights about how that was achieved, and that action resulted into creating today's bull run. Our valuation remains high on a price to earning basis. We are at 22 and a half times, highest among our peer group. But if we also look at the earnings growth, which is also elevated in the peer group, then our PEG ratio remains reasonable. It's not expensive like countries like Australia, UK, Mexico, Canada, Japan, and US. On a PEG basis, we are reasonably valued, not expensively valued like it is visible on PE ratio basis. Inflows into emerging markets have started as talks of American rate cut has begun. FPIs in the month of February has turned buyers after selling in January. Our biggest competitor remains China. And if we look at domestic flows, like India moving markets in China, then this large inflows received last month gives probably the confidence that Chinese market seems to have bottomed for the near term. Valuation-wise, China trades at a discount to its historical average. The blue bar represents the range and current number is below the range. Unlike India, where current valuation is above the historical average. From a valuation point of view, China indeed gets support based on below historical average valuations. For India, return on equity of corporate India has bounced back in post-COVID era, and leverage has been continuously falling since 2015. December 23 quarterly results came in line or ahead of expectations for majority of company. Sectors like auto, oil and gas, healthcare, real estate, PSU banks, and industrials delivered in line or above expectation results. Sectors like IT, private sector bank, consumer staple, chemical, and consumer delivered return, which were below delivered results, which were below expectations. We still believe going forward for next year as well as year after, domestic focused companies will deliver better return than global sector linked companies. We believe Nifty will touch about 1142 rupees earning per share for March 25 year ended, and Nifty 500, the broad market will touch about 903 rupee. The small and mid cap continues to trade in an unattractive valuation based on historical averages. The small and mid cap today are roughly about 37% of total market cap. Normally, in the past, when small and mid caps have reached this level, large caps return have outperformed small and mid cap. The market cap to GDP ratio at 132% looks on the higher side. Valuation across large, mid, and small is above historical averages, as profit to GDP ratio also remains above historical averages. Large cap trades at 12% premium to historical average, mid cap at about 14% premium, and small cap at about 39% premium to historical averages. The undervalue of market is stocks where floating stock is very, very limited, and typically lower floating stock has resulted into significant performance. These are the places where investors should exercise caution, as valuations and prices are in uncharted territory. The same is also reflected on a chartistic basis. Our outlook on the market in the small cap, it is a red signal, as valuation seems to have gone ahead of fundamentals. Mid cap is amber signal. Some mid cap companies are in line with their fundamentals and some are little ahead. The large cap continues to remain in green signal. Valuations are fair, neither cheap nor expensive. Our recommendation at this point of time, previous slide please, will be to maintain neutral weight to equity with marginal underweight to mid cap, underweight to small cap, and overweight to large cap category. What we are practicing, we are preaching in our portfolios. The Kotak Balance Advantage Fund allocation is about 52%, which is right in the middle of its range of 20 to 80% in equity. Multi-asset allocation fund is at about 57% allocation, when the range for equity is roughly about 10% to 90%. In both cases, we are neutral to our equity allocation. Going forward, we believe markets will be influenced by events like US Fed pivot, election results, oil prices, and consumption recovery. If events are favorable, markets will rise. If not, markets will fall. From an investment point of view, on a rolling return basis, next slide please, our funds have continued to add value to customers in our equity as well as hybrid funds. On a point-to-point return, bearing few exceptions, our funds have delivered better return than benchmark indices across equity and hybrid fund. The SIP return in some cases have turned negative alpha, but if you look at absolute numbers, they are still fairly decent numbers. We believe over a period of time, we will still be able to add value to our investors by outperforming benchmark indices. Kotak Multi-Cap Fund has Triveni Sangam of large, mid, and small cap. It has consistently added alpha over benchmark indices. Kotak Equity Opportunity, which is a blend of large and mid-cap fund, has also delivered positive alpha over benchmark indices for a long period of time. Kotak India EQ Contra Fund also consistently delivers better return than benchmark index. Coming to debt market, US inflation is trending down on headline as well as core basis. This has turned US interest rates into positive real return rates. The treasury yields are on the softening side, led by comments by Fed. Market is expecting US Fed to cut rate by mid-24. We think there is a better chance for rate cuts to begin towards end of 24 rather than early. Either ways, the RBI has managed liquidity through variable reverse repo auction. Retail inflation is continuously moderating thanks to the proactive steps taken by the RBI. From fixed income point of view, this is time to go and buy longest possible maturity. As higher the duration, better the chances of return if interest rate falls. Interest rates, like equity, will be influenced by events, but we believe thanks to the proactive management by RBI, there is good chance that India's term premium will come down and interest rates will witness fall even before policy rate cuts begin. In the debt investment, do consider our fund, Kotak Long Duration Fund. The NFO of this fund has just closed recently. It will be open for subscription in near term, next week or so. Do consider investment in Kotak Long Duration Fund to take benefit of falling interest rate scenario. Dynamic Bond Fund, Harfan Maula Fund hai. It has delivered good return over cycle. If one is not wanting to take risk of long duration bond fund, then they can consider dynamic bond fund for appropriate investment. There are many people who have invested in low volatility products like bank fixed deposits, small savings. They need to be educated about hybrid funds, especially funds like Kotak Equity Savings Fund, with about 29% average equity allocation over last 9 years. We have delivered upside participation of 42% and downside participation of 13%. That's almost upside downside ratio of 3 times. And it provides good post-tax return for a conservative investor. Kotak Debt Hybrid Fund is again combination of equity and fixed income, with equity kept at 25%, consistent alpha generation and double-digit return since inception. Kotak Equity Savings Fund is another fund which we have been recommending people, especially for conservative investors. It has delivered almost double digit return or high single digit return over last many number of years. Gold, we continue to remain bullish since March 20, bearing 2021 when gold call didn't deliver positive return. By and large, our gold call has worked out. This is primarily driven by central bank buying over last 8 months on a consecutive basis. Many of these buyers are holding cash, are holding gold in the spot market. The central bank's buying is touching about 1,000 tons a year. Gold prices invariably get supported when US interest rate starts falling. It has happened in the past. It should repeat in the future. Clearly, falling interest rates in US in second half of CY24 could boost gold prices higher. One note of caution, all ETFs in US have witnessed profit booking and outflows. If those investors decide to come back, we may see further rally in gold prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.